Welcome to the deep dive. Today we're looking at Klarna's first earnings report as a public company for Q3 2025.
And it's a fascinating one.
It really is. I mean, they post this massive record growth, and then the stock just plummets. It fell almost 9% pre-market.
And that's the puzzle, right?
Yeah.
That's what the market is reacting to. Our mission today is to figure out that exact contradiction. Why does such high growth spook investors?
And what does their forward guidance tell us about when that growth actually turns into, real profit?
Exactly.
So let's jump right in with those headline numbers for Q3. Total revenue was $903 million.
Which is up 26% year over year. I mean, that easily topped what Wall Street was expecting.
For sure. And gross merchandise volume, or GMV, that hit $32.7 billion.
Also up 23%. These are just extraordinary numbers for a company of this scale. It shows real momentum.
But then we get to the bottom line, and that felt like a bucket of cold water.
It did. A net loss of $95 million.
Which is a huge drop from last year, when they actually had a net income of $12 million. And that, right there, is why the stock got hammered.
Absolutely. The market saw that loss and immediately thought the growth was too expensive. And it all centered on their key metric, transaction margin dollars, or TMD.
Right. That came in lower than last year, $281 million versus $300 million.
So investors see expansion, but they also see shrinking margins, and, well, they panicked.
Okay, so that's the core conflict. Huge growth, lower margins, big loss. But the company is saying this was a planned lag. We should probably unpack that carefully.
Yeah, this accounting detail is really the key to the whole story.
So what exactly is this planned profitability lag?
It's all about their fastest growing product, fair financing.
The longer-term loans.
Exactly. So when Klarna issues one of these new loans, accounting rules force them to recognize the entire estimated provision for credit losses immediately, upfront.
So the full potential cost hits their books in Q3.
Right away. But the money they make from that loan, the revenue, that doesn't come in all at once. It accrues over the entire life of the loan, maybe 6, maybe 36 months.
So in Q3, they accelerated issuing these super profitable long-term loans, which meant they booked all the costs now, but the revenue gets spread out over future quarters.
Precisely. They were basically penalized by accounting rules for scaling their most strategic product.
It's an interesting question then. If they knew this was going to happen, why not prepare the market a bit better? It feels like it caught everyone by surprise.
Well, their argument would be that they're focused on the long-term value. And they did try to give a different metric to sort of explain the underlying health.
What was that?
They pointed to TMD based on realized losses. So if you strip out those big upfront provisions, the underlying margin actually grew 25% year over year.
So they're saying the core business is actually getting stronger.
Incredibly strong. They're just paying the accounting price for growth right now.
Which brings us directly to the forward guidance, because that seems to validate the whole strategy, doesn't it? The turnaround they're projecting for Q4 is huge.
It's massive. For Q4, they're guiding for revenue to blow past $1 billion. The target is between $1,065 and $1,080 million.
And GMV up to around $38 billion.
Yeah, but the real kicker, like you said, is that transaction margin dollar forecast.
That's the number.
That is the number. It's expected to jump to between $390 and $400 million.
Wow, so that's an uplift of over $100 million just from Q3.
Exactly. That's the proof. It shows that the revenue from all those Q3 loans is finally starting to flow in without the big upfront cost hit in Q4.
A classic case of taking the pain now for a much bigger gain later. Okay, let's talk about where this is all happening. It feels like the U.S. market is the real engine here.
Oh, without a doubt. The U.S. is everything. U.S. revenue was up 51% year over year.
51%.
And U.S. GMV grew 43%. They are, in their words, significantly outpacing their nearest competitor here.
And that growth feeds the whole network. How big are we talking now?
It's enormous. 114 million active consumers. And maybe more importantly, they added a record 235,000 merchants this quarter alone, bringing the total up to 850,000. That's a 38% jump in merchants year over year. The acceleration is just incredible.
So which products are driving this? We know fair financing is key, even if it caused that accounting headache.
It's absolutely central. Its GMV grew 139% globally, but in the U.S., it was a staggering 244%.
244%.
And management calls it highly strategic for a reason. Its lifetime margin is more than double the average for the whole group. It's their premium product.
And they still see a lot of room to run with it. They call it tons of opportunity.
Well, yeah, because the penetration is still pretty low. It's only available at about 151 100,000 merchants right now. That's just 18% of their merchant base.
So if they can roll this out to even half their network.
The growth we're seeing now could look tiny in comparison.
Okay, so fair financing is the hook for those big purchases, but the other driver is the Klarna card. It feels like that's the play for everyday spending.
That's the whole strategy. Make Klarna a daily habit, not just a checkout button. The card launched in July, and they got 4 million signups almost immediately.
4 million.
By October, it was already 15% of all their global transactions. And it's aimed at a very specific group they call self-aware avoiders.
The people who want the perks of a credit card but are genuinely scared of getting into debt.
Exactly. It's a debit-first product, so you feel in control, but it has the rewards and perks of a credit card. It solves a real psychological pain point.
And the value of getting a customer to use the card is, it's immediately obvious in their AR pack numbers. The average revenue per active customer.
It's night and day. That metric is their whole game plan. A basic user, someone using Pay in 4, generates about $28 in AR pack a year.
Okay.
But the moment that same user gets the Klarna card, their AR pack jumps to $130.
Whoa! That's more than 4 times the value.
4 times. It's an unbelievable incentive for them to push that card rollout as hard as they can. It's how they turn a casual user into a core banking customer.
All right, let's shift to operational efficiency, because these numbers are, frankly, just as impressive as the growth.
The operational leverage might be the most impressive part of the whole report. Think about this. Since 2022, revenue is up 108%.
Which is fantastic.
But their adjusted operating expenses over that same period, they grew only 2%.
2%, that's insane. To grow the top line that fast while keeping costs almost totally flat is just remarkable discipline.
It is. It means they've built a machine that scales incredibly efficiently. And you see it in the employee numbers. Revenue per employee is now $1.1 million.
Up 3.2 times since 2022.
And they did this while their headcount actually shrank by 47%. Through natural attrition.
So they're not doing layoffs, they're just replacing roles that people leave with AI and automation.
Precisely. And they have the numbers to back it up. Their AI assistant is now doing the work of 853 full-time agents.
Which they calculate as a $60 million annual cost saving.
So AI isn't just a buzzword for them. It's a core part of their financial model. It's what creates that leverage.
And this all feeds into the CEO's, Sebastian Siemiatkowski's, really broad, almost existential vision for the market.
He's basically declaring war on the old models. He calls traditional banks and pre-AI tech companies malfunctioning markets that rely on locking customers in.
His big thesis is trust is the new oil.
Not data anymore, but trust. He's betting that complexity and hidden fees are a dead-end business model.
Because AI is going to make everything transparent.
Exactly. He thinks AI agents will kill information asymmetry. Consumers will instantly know who's ripping them off and they'll leave. Klarna wants to be the transparent, trusted player waiting for them.
And by doing that, they're not just playing in the buy now, pay later space. They're going after huge markets.
A massive combined $1 trillion opportunity. They're targeting the $520 billion in retail banking and another $570 billion in digital advertising.
And right now they have, less than 1% of the global retail banking market?
Something like 0.6%, so they've barely even started.
So let's look at the roadmap to actually capture that market. Objective 1 is to become a global payment network, basically on par with Visa.
The goal is 150 million acceptance points. To be everywhere Visa is. And they know they can't do that one merchant at a time.
So they're working with partners.
Payment service providers, yeah. Your Stripes, WorldPays, Apple Pays. The idea is to make Klarna an embedded default option, not just another button at checkout. They just added Clover this quarter, which is a big deal for in-person sales.
And that network is the top of the funnel for becoming a full neobank.
It's the whole customer acquisition engine. We talked about the AR pack. They draw you in at checkout where you're worth $28.
Then you get the app.
And you're worth $30. Then you start using the shopping features, you're worth $90. And then they get you on the card or bank offer, and you're worth $130. Each step is a massive value increase.
With all this growth in fair financing loans, you have to ask about risk. Are they taking on more risk to get these numbers?
Well, the data says no. The realized losses actually fell a tiny bit to 0.44% of GMV.
Which is very low.
It is. And they point to their 20-year history. They've underwritten $500 billion in loans with losses under 70 basis points. Plus, their loans are short duration, so they can adjust their underwriting models in about 40 days if the economy sours.
And they made a huge move this quarter to de-risk their balance sheet with that Elliott deal.
That was a brilliant move. They got a forward flow agreement with Elliott Investment Management to buy $6.5 billion of these fair financing loans.
So that gives them liquidity.
A ton of liquidity, yeah. But it also lets them recognize the revenue from those loans faster because the risk is off their books. It's a huge win. It validates the quality of their loans and frees up capital to grow even faster.
And what's their take on the broader macro environment?
The CEO acknowledges it's choppy. He even mentioned a risk most banks aren't talking about, which is AI impacting white-collar jobs. But he said so far they see no material differences in how people are paying back loans.
Which probably says something about the type of customer they attract.
Those self-aware avoiders are probably more financially disciplined to begin with.
So, to wrap up the Q3 story, overwhelming growth, especially in the US, driven by these key products. They took a deliberate short-term profit hit because of accounting rules.
For scaling up their best product.
Right. And the forward guidance for Q4 promises this huge profit recovery that basically proves the strategy was sound.
That's the definitive takeaway. They chose market share and network dominance now, knowing the profits would compound later.
And it all comes back to the CEO's belief that AI will make ignorance an impossible business model.
It does. And that's the final thought for you to chew on. If he's right, if AI really does eliminate all the complexity and hidden fees that traditional finance is built on, how fast does that industry collapse?
How quickly does all that trust in business shift?
Exactly. Will incumbents even have time to react? Klarna is betting that the change will be almost instant. And this quarter showed they're willing to pay the price to be on the right side of it.